Jack Bogle launched the first index fund back in 1976, and since then, these funds have taken over by not only giving the average investor the opportunity to outperform most professionals, but also save average people like us billions and billions of dollars. There's a reason why the top 3 ETFs are all S&P 500 funds with assets under management of almost $1 trillion. Because that type of fund just works. But what if there was a newer kid on the block? One that takes the same 500 companies within these S&P 500 funds, but changes up how the whole thing works. Is it better? Would it outperform? Are there any risks that aren't so obvious? And is this something that you should be investing your money into? In this video, we're going to dig into this S&P 500 index fund spinoff to figure out what's really happening here. At a basic level, the S&P 500 is made up of the largest 500 US stocks. 99% of you watching this have heard of most of the companies at the very top. But as you move towards the bottom of the list, it's less likely that you've heard of a lot of these companies. An S&P 500 ETF like SPY and VOO are traditionally market cap weighted. All this means is that the larger companies make up a larger portion of that fund. It's weighted based on its size, hence the name market cap weighted. So since Apple has the largest portfolio weighting of around 7% within the Vanguard S&P 500 ETF, $7 will go into this stock for every $100 you invest into this fund. All the way down to the smallest company, which is Dish Network, where 1 penny will go into that stock since it makes up 0.01% of the S&P 500. With a market cap weighted fund, you're allowing the winners in your portfolio to continue growing and reducing or limiting your exposure to the losers as they decline in size, which essentially means that this type of fund is more momentum based. The best recent example is Facebook or Meta stock. It used to be in the top 10 of the market cap weighted S&P 500 index fund, but since its stock price has dropped by roughly 60% over the past year, the weighting towards that company has fallen. So less money is being allocated to that stock and more is being allocated towards stocks that have performed better. What I'm calling the spin-off way of investing in the S&P 500 takes an equal weighted investing approach to these 500 stocks. Instead of assigning a weighting based on the size of the market cap, it assigns the exact same weighting to every single company no matter how big or small it is. So instead of Apple making up 7% of the fund, it would only make up 0.2%. And instead of Dish Network making up 0.01%, it's now at 0.2% as well. With an equal weighted fund, you're continuing to cut off the growth of a better performing stock to sink more money into the declining stocks that might not ever come back. This is more like a value-based investing strategy. Right off the rip, something seems to be off with that. On what planet would someone put a wildly successful company like Apple and a company like Dish Network on the exact same playing field? And why would you continue to punish the good companies by selling them off to buy into these smaller companies that haven't yet shown that they deserve a higher weighting within your S&P 500 fund? Well, if you think that those smaller S&P 500 companies have a better chance of growing than the big boys, then this might make sense. But we'll talk about a better solution to take advantage of this later in the video. If we compare an equal weighted S&P 500 ETF against a market cap weighted ETF, then we can see that the performance of an equal weighted S&P 500 fund has slightly outperformed the market cap weighted one over the past 19 years. It's not so obvious, but keep in mind that for the equal weighted fund to outperform the cap weighted fund, it has to take on additional levels of risk. Now, from a risk-adjusted perspective, historically, the market cap weighted fund has actually outperformed. But does the past outperformance mean that you should ditch market cap for equal weighting? Of course not, because there's always more to the story, which is also why you should never pick your investments purely based on past performance. If you're enjoying this video, please help support my dog Molly by hitting that thumbs up button, tapping that subscribe button, and notification bell as well. Another thing an equal weighted S&P 500 fund has going for it is reducing concentration risk. It spreads your money across different sectors, not based on size like the cap weighted fund, but based on how those sectors are represented within the S&P 500. This is good if you're worried about too much money being concentrated into a specific sector. Here's a quick comparison to show you how different the weighting actually is. Since tech makes up a larger portion of the market cap weighted fund, if that sector takes a big hit, then it's going to hurt that overall fund more than it would an equal weighted fund. But on the other hand, since industrials make up a larger portion of the equal weighted fund, if that sector starts to drop, it's going to hurt it more than the cap weighted fund. So it's pretty much a double-edged sword no matter which fund you use. The equal weighted fund just evens things out a little more than a cap weighted fund, which is dictated by what the market has decided based on the overall long-term earnings. One of the biggest concerns that I hear about a cap weighted index fund in today's environment is that there is just too much allocated towards tech stocks. As an investor in a market cap weighted index fund, you're admitting that you're okay with this, knowing that in the short term it might be a little concerning, but over the long term the market has always and most likely will always self-correct, so there's really nothing to worry about. The first main downside of an equal weighted fund has to do with the fees. Because a market cap weighted fund is less active, the fees are going to be a lot lower. On the other hand, since an equal weighted fund is a little bit more active, it's going to cost a lot more money. The current fees for an equal weighted fund like RSP is 0.2%. Compared to a lot of other funds, this isn't that expensive, but if we were comparing it to a solid cap-weighted S&P 500 like VOO, the equal-weighted fund is over 6 times more expensive. As with all funds, the expense ratio isn't the only cost that you pay for though. There are also indirect costs that you need to be aware of, like fund turnover. Fund turnover measures the percentage of holdings within the fund that are replaced throughout a 1-year period. A higher number means that there could be capital gains that are distributed to the investor, which would force you to pay taxes that you weren't expecting to. What is considered a high number is relative to the type of fund that we're talking about. An example of a super high turnover is that of ARK Invest's flagship fund, where it's sitting at 55%. With an equal weighted fund, the current turnover is 18%. While it's not 15%, it's still pretty high, and even higher when we compare it to a cap-weighted fund like VOO, where the turnover is only 2%, 9 times lower. An equal-weighted fund also has another downside: higher volatility and sharper drawdowns during stock market declines. When we compare its 8 largest drawdowns to a cap-weighted index fund, you see that it has dropped much lower during 7 of the 8. The one where it hasn't dropped as much is the time period we're currently in right now, so it's ongoing. This is something very few people like to pay attention to before picking a fund to add to their portfolio. We all want to pay attention to the returns of the fund because that's the sexy thing to look at. But understanding how that fund performs during the bad times is just as, if not more important, because if you can't continue to stay invested within a fund when it's underperforming, then it's pointless to even buy it to begin with. Unfortunately, I think humans underestimate how they're going to react when the market is down. On paper, it's easy to say, oh yeah, I could handle that. But being able to stick to that when it's actually happening and you're watching yourself lose money is a whole different skill. By equal weighting all of the S&P 500 companies, we are, by definition, putting more weight on smaller large cap stocks, which could be considered mid or small cap companies. This means that the fund will end up overweighting mid or small cap stocks by 30 to 40% compared to a cap-weighted S&P 500 index. If tilting a little bit of your portfolio towards mid or small caps is your goal, then instead of holding one equal-weighted fund, you might be better off just looking into choosing a cap-weighted S&P 500 fund and a mid or small cap value fund as well. Doing it this way is going to cost you less money, reduce turnover, and improve your risk-adjusted returns. When we look at the past performance over the previous 19 years, we have to remember that that does not mean an equal-weighted fund will continue to perform the same way going forward. If you had invested in this type of fund from the very beginning, then congrats. But I'm assuming very few of you, if any of you watching this, have. And if you were thinking about adding it to your portfolio, or someone is trying to talk you into it based on past performance, then don't do it until you've really thought this through. An equal-weighted fund could in fact continue to outperform. But what if it doesn't? Are you going to jump ship and sell at the first sign of underperformance? What about if it continues to underperform over the next 19 years? Because if not, then it might make sense to just stick with market cap weighted traditional index funds or index-based ETFs, because you know that you will actually hold on to those and just accept your average market returns. You have to take the downside in your human behavior into account before making any investment decision, because if you don't, then the next thing you know, you're 20 years down the line and have accumulated a bunch of different random funds. I show you why this is such a big problem in this video to your left. Hit that thumbs up button, subscribe button, and tap that notification bell before you go. In the description will be more resources to help you with personal finance, investing, and financial independence. I'll see you in the next one, friends. Done.